And we're back. So today we're going to be discussing self-employment income on your income tax. For the sake of this video, we're going to be following the Schedule C, which is the schedule most often used for sole proprietorships and sole member LLCs. Okay, income, part one, income. It doesn't get much more straightforward than this on taxes, but there are some subtleties to go over. Let's say I'm in business and I sell, well, there should be, I don't know, I sell hats or I sell these. Okay, little styrofoam tubes that light up, although this one doesn't light up, battery's dead. The total amount that I collect on this is considered my gross income, with one exception for the purposes of the Internal Revenue Service reporting. Don't include your sales tax. So if you live in a state that has sales tax and you sell this and you sell it for $10 per unit, you live in New York State, so you're paying, or you're receiving $10.90 per unit, and you're taking that 90 cents and sending it off to New York State. Don't include that in the first place, okay? If you insist on including that, then make sure it's deducted later in the return, and we'll talk about that. But as per IRS rules, you do not include sales tax in the top line. Therefore, if you add up all your deposits in your bank account, that number will, if it's a sales taxable endeavor, that number will necessarily be greater than the number you show on your tax return. And of course, any IRS examiner is going to know that. It is what you collect, gross amount, including what you later return. So I sell two of these and one of them comes back to me. So on the top line, or my income, gross income, I put $20. But guess what? One of my customers returned it and I had to give him $10 back. Well, don't just remove that from the top line. Let us know, or let me know, I had returns of $10. Now, this is where it does get a little complicated. The one deduction we're going to talk about in this part or in this video is cost of goods sold. What's cost of goods sold? Well, what did I pay for these, right? So I sold them $10 each, but I paid $5 for them each. So my profit margins are 100%. I buy them for $5, I sell them for $10. But whatever you're selling, if it is a tangible goods, this doesn't apply to services. Let's say because I'm a tax accountant, so I have to buy, a computer and another computer and battery packs, whatever. Whatever I need for my business, you may think, oh, cost of goods, the goods I use. No, this is specifically cost of goods sold, otherwise known as inventory. And this has got to be the biggest bane of my existence, is explaining or helping people understand this. Now, to me, it's super straightforward, but I think where it gets confusing for people is how to calculate end of year inventory. So we're going to go through an example here. I start the year in business the first time. So January 1st, before my business has even started, what's my inventory? 0. I don't have inventory. No big deal. I buy a case of these. Let's say there's 10 in a case. And that's all I bought for the whole year. So that is my purchases. And that's one of the lines, your purchases for the year. Not what it's worth, not the retail, your cost, actual cost, what you paid for it. So, and you shouldn't be paying sales tax on it. Whatever state you live in, you should not be paying sales tax if you are a go-between and selling it to somebody else and they are paying you sales tax that you remit. So sales tax should never be there, but if you're somehow paying sales tax per unit when you buy them, then you're going to put that as well in cost of goods sold. And I bought a case of 10. So what's my total purchases for the year? $50, right? 10 of them times $5, $50. So I tell my tax accountant, my purchases for my inventory, what I sold and still have in inventory, was $50. Now I sold 2 units. So I have to remove 2 units, the cost of the goods sold. So 2 units, $5 each, I take $10 off that, okay? So what is my year-end inventory? Not that difficult, right? 50 minus 10, what I sold, I no longer have in inventory. My inventory on 12/31 of the tax year is what? Well, if I sold 2, I have how many left? 8, right? So 8 times my $5 per, I have $40 left in inventory. I don't care what your selling price is. That doesn't matter. All that matters is what you paid and what was taken out of that inventory. So at the beginning of the year, if it's a new year in business, 0. At the end of the year, whatever's left over in your inventory, in your possession at 11:59 p.m. on the last day of the year. Now this is where it gets a little trickier. Now let's take the second year. So we're starting the tax year, January 1st, with $40 in inventory. We are buying another case, another $50, so we're up to $90. We sell only one. We take $5 off of that. What's our year-end inventory? $85. So what's our cost of goods sold? Beginning year inventory minus end of year inventory. $90 minus $85 equals $5. Our cost of goods sold is $5. Where this gets complicated for people is when they're buying used goods and they're buying lots of goods and they don't want to keep track of them. Where I run into that most is with people that work like antique shops or like thrift stores or flea markets, I guess is more what they'd be called. These people are notoriously poor at keeping track of the value or what they paid. But that's what you have to do. That's how you determine what everything that you sold cost you to get the number that you're even starting with before you get your other deductions. So I think that's more than enough for this video. Again, income, returns, pretty straightforward. Cost of goods sold, get a little tricky. And then you're going to have the number from which we're going to take all the standard deductions that you're thinking of, like cell phone and mileage and meals and entertainment and credit card fees and so forth. But we'll get to that next. Thank you for watching. And if you have any questions, please let me know.